Good morning. It's Monday, February 10th, 2025. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer for Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic commentary. If I have something to say intra-week, I'll be sure to post it on LinkedIn. Please follow me there, Herb Morgan. And also on X, you can follow me there at Herb W. Morgan. The presentation you're seeing, or just hearing, if in the case of a podcast listener, has been prepared by me for use with you. It matters not whether you are an investor or a financial advisor. You are all expected to make your own investment decisions. Nothing contained in the presentation should be treated as investment advice, tax advice, or the recommendation to purchase or sell any security. Everything is purely for informational purposes only. The views expressed herein are mine and mine alone, may differ from the views of CFIA's parent, affiliate, or other portfolio managers at the firm. So, where the last 2 years have been all about U.S. equities, all about big U.S. equities, and all about tech U.S. equities. A little bit of a mixed message on some of the earnings reports in the last couple of weeks. It's sort of muted the returns. That plus concerns about tariff implementation. So U.S. equities down, S&P down 0.25% last week. Mid and small cap stocks a little more, still hanging on to positive gains for the year as we move here into the second week of February. But international markets, led by, as you can see, emerging markets. There we go. Get you the little dot, 1.4%. That was all led by China, which was up almost 2% on the week last week. We also had been worried about the 10-year yield approaching 5%. It's back down to 4.5%. So you've got the aggregate bond index up on the week and up almost 1% on the year. And the longer dated Bloomberg 20 plus Treasury bond index, big gains last week, almost 2%, now 2.5% for the year. Let's get into last week's economic data. Let's start with manufacturing. We got both ISM and S&P Global. S&P Global went into positive territory, went above 50. You can see that decisively, 51.2. You know, we had several months in a row. You can see again over here, 1, 2, 3, 4, 5 months in a row, 6 really below that 50 line, 1 now ahead. We need to see more of a longer term trend. But, you know, the services sector has been great. Manufacturing is about 15% of the U.S. economy, and it really has been lagging ever since the reopening after COVID. ISM, which is a competing reading to S&P Global, had the same thing. Here you can see they say manufacturing's been in contraction really going back to the summer of 2022. So about 2.5 years of contraction in the manufacturing sector. And then you can see this last month, January, popped above 50, but decidedly so. 50.9, it's a good reading. New orders up to 55, production up to 52.5, and employment turned positive. So manufacturing employment grew in the month of January, according to this reading. Then we move on to the services sector, which has been incredibly strong. It's not dipped really below 1 month there, maybe below 50. S&P Global says it fell a little bit to 52.9, but remember, that's not a decline in the services sector. That's a decline in the rate of expansion. So anything above 50, it expanded, and the ISM reading says really the same thing. Came down from 54 to 52.8, a little below expectations. New orders grew, but at a lower pace. Business activity grew at a lower pace, and employment grew at a little bit of a faster pace. So employment picked up really. You could see they're both manufacturing and services. Construction spending in December was expected to gain 0.2. It gained 0.5%. That's great. Residential construction picking up 1.5. I think there's still some hope for lower financing rates, but there's just demand, right? When you have jobs and you have employment, you have demand for housing. We are very much behind. That's one of the reasons prices have remained stubbornly high. Auto sales took a little bit of a drop. You can see over here, right-hand side, fell from an annualized pace in December of 16.8 million, which was the highest reading we've had in about 4 years, dropped to 15.6. And, you know, this, if you go way back, you know, we were high 17s, touching through 18 million for quite a period of time. Never got back there after the shutdown and the reopening. I think this is part of the administration's concern and tough talk around tariffs, and you know they'd like to see more autos of that are manufactured here, and sold abroad. Moving on. We also got the JOLTS report, the job openings report, and this is a little bit busy, but I usually take my data and dump it into Excel and simplify the graphs and charts. But in this case, I wanted to show this one because I really like it. The JOLTS job opening in the country for the month of December came in at 7.6 million, and that's the orange. You can see it right here. The white line here is the total unemployed, 6.8 million unemployed for 7.6 million openings. So we still have demand that exceeds supply of labor. And this is, of course, inflationary. And this is because we have a solid growing economy. And you can see back here, right, this is global financial crisis. This is the total unemployed far exceeds the number of job openings. We only had 2.4 million job openings. And then it all switched. Then we had the big gap between openings and unemployed that resulted from the reopening after COVID. If you do this as a delta, subtract one from the other, when it's green, the job market is kind of soft for employees. When it's red, the job market is very strong for employees. But we're getting closer to equilibrium. I guess that's my point. The jobs market disequilibrium has provided fuel for inflation because wage pressures obviously help to drive inflation. So it's nice to see that gap closing, at least from an inflation perspective. Factory orders fell 0.9%, kind of in line with the expectations of 0.8. This is all in December. Back out the volatile transportation component, we see a gain of 0.3 on top of a gain of 0.2 in the prior month. We had the second largest dollar volume trade deficit on record. And this is December, and this is a reflection of importers rushing to get ahead of possible tariffs, particularly those that we thought would be coming with Mexico and Canada. This was just you can see it right there, just a huge number. It grew to 98.5 billion. It's a little better than expected. That doesn't really say much. Going back to 1960, the annual was also the second largest. So it was the second largest month on record. You can see that. And the second largest year on record. Remember, trade deficits are a subtraction for GDP. That may not necessarily always be a bad thing. The trade deficits also reflect our position as the world's reserve currency, our position as the richest consumer nation in the world, and being able to afford goods imported from abroad is a luxury that Americans have because of our wealth, and the relative discrepancy in labor and other costs allows for cheaper goods here in the United States. It's jobs reports week. I'm going to start with initial claims for unemployment, which remain incredibly good and incredibly low. They've been so low for so long that the big numbers now have run off of our chart, right? This chart goes back to August of 22, so it's almost 2.5-year chart. And you can see, bottom line, we get down to around 200. We haven't even been close to 300,000 in a week in a very long time. And so we came in last week at 219, great, continuing claims, 1.9 million, not a big deal. But the confusion and the hand-wringing and all the political talk and machinations last week really came from the big reports, the ADP and the Bureau of Labor Statistics, most specifically the BLS, Bureau of Labor Statistics report. But I'll start with ADP. They say the economy added 183,000 new jobs in January. Estimated was 150, so that was great. And then they revised December from 122, revised it up to 176. So that's another 54,000 from the prior month. So that was just a fantastic report, a great report. Then you move on to the BLS, or the non-farm payrolls report. We added 143. Unfortunately, that was below the estimate. Depending on your political, spin, you wanted to sort of say that as a big miss or something like that. It was not, because, December was revised higher, significantly higher, to 307,000. In fact, the prior 2 months combined were revised by 100,000. And then it's also the month of the annual revisions, where they go back, because this isn't an exact science, this is statistics. And they go back and they say, well, what did we have? What did we didn't? So some months were revised lower, some were revised higher. And so if you were in the political sphere, you really jumped on that. But this is something that happens every year. It's not that big of a deal. The good news is we added 143,000, according to this report. Unemployment, it's the second month in a row. Remember, 2 months ago, we were at 4.2. then in December 4.1, and January now down to 4.0, and labor force participation rose to 62.6%. So the jobs market remains incredibly strong. We're happy that's the case. University of Michigan's consumer sentiment reading actually fell significantly from 71.1 to 67.8, well below expectations. Why? Consumers are still concerned about inflation, and now there's additional concern around tariffs. We don't know which tariffs will be on, won't be on, what goods will be impacted, what prices will be impacted, what that will mean to the consumer. So that amount of uncertainty, plus the persistence already of inflation, specifically in a lot of food areas such as eggs, has got consumers not feeling as good as they maybe have. Businesses are doing fine. Corporate profits are doing fine. We're later in earnings season through a lot of the big tech names now. 308 S&P 500 companies have reported. 236 of those have beat the estimates. 52 have failed to meet estimates. The average earnings surprise is 6.5% above the consensus. You look here, industrials down. Big winners, consumer discretionary. That tells you the health of the economy right there, right? Because they're discretionary. These are the things that would be expected to lose business if we were headed towards some kind of a recession. Look at financials. Financials were very, very strong. Communications, which isn't really more tech, strong. But look at tech, not what really everybody would thought. Now, we're only about halfway through tech, a little more than halfway through tech. We've only had 3 companies disappoint. But there's also been some softer guidance from some of these names. And then, of course, we had the whole thing with the DeepSeek, the AI competitor that allegedly came out, faster, better, cheaper. Plenty of economic data this week. Still nothing today on Monday. Small business optimism, which has been really at a very rapidly increasing pace the last couple of months, is Tuesday. CPI and PPI are big. This 3/10 number is high, and unfortunately, it just is what it is. Weekly jobs claims, looks like we missed the estimate there. It wasn't out when we put the slide together, but it's going to be in the low 200,000s. PPI, 2/10 would be great. Anything below these numbers would be just so well received by the markets, but they're not expected. Retail sales are expected to be flat for January. Import and export prices, same kind of problem. Industrial production, expect to be up 3/10 months over month. Capacity utilization ticking up a tenth, getting closer to that inflationary pressure that can come from capacity utilization. Thanks, everybody. As I always say, Slaying Bulls and Bears is the name of this broadcast. It's available everywhere. But if you want the charts and graphs, do it on the YouTube channel. We try to make the complex and complicated simple and sensible. Please give us a like, a thumbs up, a retweet, all those different things. Thank you. I'll be back to you again in 1 week.